Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same four LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. What we're witnessing is an at all cost protection of the officially held COMEX LBMA OCC bets against silver futures breaching very large short stops that have only just begun to be tripped off above the May 1st, 2011 50 highs, which was here. And notice that the pullbacks have come back to this level. Now these stops, the further up you get here, these stops will ignite, can really risk igniting, and ultimately will spiral into an out of control disconnect versus the globally determined spot silver benchmarks. Very short term, we assessed in our last episode and in the prior ones, while we expect 53 to be the next rally staging post, liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market, and it will require sufficient bullion to come to market for the for the short covering to be completed. Now, we were looking at futures, but in the spot market, the real spot market, which is basically driven by every single other currency, FX currency in silver, making all-time fresh highs, we have indeed seen silver testing the 53s, the mid 53s. And it's really this EFP spread which we're sort of looking at and going to explain better that is causing this disconnect. Here's a quick example of silver in offshore in the SGEI exchange, the offshore Chinese exchange. And while I'm looking at also gold. So as is evidenced by the unprecedented full spectrum backwardation into as deep as July 2028, mind-boggling, you have to look at it to believe it, and it's improved somewhat, but this is a broken market. And as we assessed last time, even into the 1979 to 1980 Hunt Brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt Brothers backwardations were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-setting physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the two remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bets. So, ICBC, Standard Banks, UBS and JP Morgan. Now, notably, and by absolutely no coincidence, last week's rushed together proposed OCC rule, there was a rule change. It slipped under the radar. Now the CME finally raised their gold and silver margins respectively from 17,000 to 18,000 and in silver from 16 to 17,500. Now by last Friday's London Open, lease rates to borrow silver to meet immediate delivery demand spiked way north of 24%. We're using 24%, but it was actually over 30%, driving the silver short squeeze EFP basis spreads that we just talked about. And here we captured it here live at a huge $2.80. That's $14,000 per contract difference. In fact, it has been as high as $3 or $15,000 per contract. Now, the expanded basis spread misplaces the spot equivalent fix. So to illustrate, we spot adjust it in and demonstrate it in green at the fix hours. And as you can see, it is substantially higher than the COMEX, where we actually place the equivalent COMEX fix. At the peak, we captured these unprecedented futures backwardations extending all the way through to July 2028. This is mind-boggling. It's unprecedented. It illustrated mispricing COMEX silver market futures are completely broken. The market's broken. Whereas in real time, we're evidencing the SGE-centric physically settled global spot markets shaking this COMEX tail. It's amazing to me that how few people have actually woken up to this huge breaking of the COMEX. In fact, the SGEI silver prices are setting local London spot prices, consistently one-to-one mirroring the fresh highs in spot silver as well as gold. And in short, the unprecedented supply constraints, there is hoarding alongside strategic positioning around critical minerals leading to global export controls, have left London silver cupboards absolutely bare. Now worse, unallocated undeliverable local London FX obligations that have been so-called hedging these COMEX short positions. So when they're called on for physical delivery, these bets in London, these bets are impossible to cover into globally driven, higher physical priced demand. And what it's done is exposed these asymmetrically mismatched LBMA CME derivative bets as naked. Now these bets are being called in. That's what's happening, threatening default if they're not brought back at higher prices, further tightening supply.
Please subscribe to our channel and activate the bell icon to receive timely updates.